Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 30th of October. It remains a turbulent time in markets, quite apart from any concerns around the ongoing Middle East conflict. We've also had a situation where economic data in the US is very much still pointing to interest rates staying higher for longer, the most recent data being a strong US GDP reading. Of course, higher interest rates does tend to mean that the potential for future stock appreciation is more stunted, and certainly we've seen a situation where bonds have become rather more in fashion than equities over recent months. At the same time, in terms of the current earnings season, the Magnificent Seven in the States, the big seven mega cap technology stocks which have driven a lot of gains, have reported some fairly mixed earnings, admittedly against quite a high bar. That being said, the most technology-focused US indices are still ahead in the year to date. And if we look at what's happened so far this year, the Dow Jones is now down by 1.1%, S&P 500 is up by 7.8%, the Nasdaq by 20.4%, and the FTSE 100 has also retreated into negative territory, down 1.1% so far this year. Turning to next week, we've got numbers, third quarter numbers coming from the oil majors, BP and Shell. BP shares are up about 15% over the last year. Shell shares are up about 17%. Any number of things to look out for. Obviously, the higher oil price will have improved cash flow for both Shell and BP, quite apart from the fact that Shell are currently yielding about 4.1% in terms of the dividend, BP 4.5%. There's certainly scope for further shareholder returns in terms of buybacks, let alone their ability to pay down debt, which has been an investor focus, and potentially invest more in renewable energies. So there's quite a few things to look out for, and certainly with Brent oil currently somewhere around $90 a barrel, the so-called cash balance point, which BP basically levels out at about $40 per barrel, gives you some idea of the scope of potential profit there. Third quarter numbers also next week from Next. Shares have had a very good run over the last year, up about 33%. A lot of this, of course, will be on the basis of several profit upgrades. The current number for full year pre-tax profit is £875 million. Let's see if that's changed again. Of course, the total platform, which includes third-party people basically using Next technology, is something it sees as a major growth engine in future years, including internationally. And it'll also be interesting to see how the online reversion to the mean of physical store shopping as opposed to online has taken over the last 3 months or so. That being said, of course, Next is well placed on both. Finally, third quarter numbers from HSBC. It's been a fairly torrid time in the banking reporting season so far. It doesn't seem terribly likely that HSBC will be able to change the dial. That being said, they have had a good run. They're up about 37% over the last year, the shares. But we can still expect to see very much an investor focus on both net interest margin guidance, which has been cut almost across the board by HSBC's competitors, and a further raise potentially in credit impairment or bad loan provisions, which again, unfortunately, has been a theme of this season. We've also got the additional concern, of course, as we saw with Standard Chartered, that HSBC has a fairly high exposure to the Asian regions, where the Chinese economic recovery in particular has been stuttering. Thank you for watching. Have a great week.